Welcome everyone to the May Focus series. Today we're focusing on guiding clients through complex decisions, specifically around retirement planning. Now, if we think about retirement planning, we know that the goal of retirement planning is to help clients achieve the retirement they want with as much certainty as possible. But we know that certainty is difficult. It's influenced by so many different factors. If we think about just everyone on this call, we're all going to have our own views, our own perspectives, our own house views on how we approach retirement planning and what assumptions we use. Even the experts disagree sometimes or struggle to agree on all the different levers. But the goal of Asset Map is to surface what are those material levers and how do we bring that into our conversation with clients. And often when we think about retirement planning, we think about it in these two phases. Those clients that are still working towards retirement, and there the conversation is around, are they on track? What are the different behavioral or financial changes that they can make to help give them the best outcome? We want to provide clarity. When we've got clients that are in retirement already, then the conversation shifts a bit. It becomes about balancing, giving them the best life they can live in retirement with ensuring that they can continue to have that lifestyle for their lifetime. It's also where we start thinking about later life conversations and legacy conversations, not only in retirement, but, it comes up a lot there as well. So as we move through the presentation today, the emphasis is going to be what are those different levers and how do we bring those conversations in to both pre and post retirement. So if we have a look how we're going to go through it today, I'm going to start by working through a client that's in that pre-retirement phase. They're building towards retirement. And then we'll take a look at a client that's in retirement already and what are the different conversations there. And as we work through it, we'll talk through what are those key drivers, those different levers and assumptions, and how do we surface those conversations, including assumptions like taxation. So let's start. I'm going to just jump into Asset Map. Perfect. All right. Then you can just give me the thumbs up when you can see my Asset Map screen.
Let's just come through.
So the first client we're going to look at is Katie. Now, Katie is 45, so she's still in that, building towards retirement phase. And we could just taking a look at some of the financials that Katie has. She's earning an income of $720,000 per annum. She's also got a rental property that is still bonded, and she's earning an income on that each year. She's got a retirement fund that she's contributing towards. She's also got a unit trust investment that she's also contributing towards, and she's expecting an inheritance to come in the future. So we've put that in as a future asset. And of course, for Katie, the conversation is around, is she on track for retirement based on the savings that she's already, saved up until now and what she's contributing? How on track is she? And what are some of the things we can do differently? So if I jump across into target maps, and we open up a target map for retirement for Katie. Now remember, when we create a target map for retirement, it immediately comes up with an answer, and that's based on whatever assumptions we've put in to the target map preferences. So we start off by looking at what is it that Katie wants retirement to look like for her. And we can see here that by default, we're looking at, her needing an income of $450,000. I'm just going to open a pen here of $450,000 per annum. She's, we're starting off by assuming she retires at 65 and that she would want that income each year till age 100, and it needs to keep up with inflation at 6%. So cost of living adjustment. But we've also put in an assumption for travel. That's always a fun conversation with clients around what sort of travel retirement they want to include. And then, of course, medical as well. So we've split it between 3 different needs so that we can have different start and end ages or different escalations if need be. But this is really the starting point. Now we'd have that conversation with Katie around what does retirement ideally look like for her. And of course, we can edit any of these line items. So I can open it up, Perhaps we want to change the wording or just take out, the brackets here. We can update the amount that Katie wants. We can look at changing the start and end ages. And this is always, again, surfaces a conversation around how long do we plan for? Often planners will say, clients tell me, I won't live past 85, and they only want to plan till then, or we want to make sure that if they live longer, that we can make that last. So this really starts that conversation. And of course, having a conversation around inflation. This is the need today, but we need it to keep up with that cost of living adjustment each year. So all of that can be edited as needed. And of course, I can add in additional desired needs that a client might have. So we can really customize this what you want section to be exactly what her needs are. And then what we see over here is it says, okay, if this is what we want retirement to look like, then this is the amount of capital we would need today, assuming an expected return of 8%. Okay. So that's our starting point. The next step is we want to look at what does the client have that we can put towards this goal. And here is another opportunity to look at and to expose or surface certain conversations. The first one I wanted to include is rental income, because this comes up quite a bit where a client might be receiving rental income and they're receiving it now already. So Katie's 45, she's already receiving that rental income. But the question we want to ask is, are you saving that rental income now before retirement for that period from now until you retire? In this case, Katie's using that to fund the bond payments and to fund other expenses. So it's actually not being saved. So we don't want to bring it in from today, but rather want to bring it in from retirement, because we're assuming through that conversation with her that bond will be paid off before she retires, and that income can be used to help fund the needs under what you want. So we select it here, we bring it in from age 65 till age 100. And also, what assumption do we make here in terms of whether that rental income will increase? And so again, it highlights an opportunity for conversation around, can we expect that it'll keep increasing by inflation year on year? And also creates a conversation around how dependent we can be on rental income. What happens if if it doesn't pay for a certain month, or there's a trouble in a certain year? What is the impact of that? And of course, we deduct taxes as well. Then if we look at what she's currently contributing to her investments, she's contributing to her employer fund. So we're going to bring that in from now till age 65. That's what we're adding in to the parts that can be used to fund her income later. Again, we've assumed an inflationary increase. Now, these default to 0, so they don't automatically increase, but it's, again, a conversation we can have around, should we be putting in an inflationary increase or another increase to increase those contributions over time, as well as the unit trust. And a key point I want to just talk through here, if we look at that rental income again, what it's telling us over here is that this rental income that Katie is going to receive in retirement of $180,000 per annum, increasing at inflation less tax, is the equivalent of having $2.2 million invested at 8% today. So we can say, either or, if I had 2.2 million or that income of 180,000 per annum, it's worth the same. Right, just want to point that out. And then if we go down to the assets, this is where I select what can we include. So we can include the current value of their retirement fund as well as the unit trust. Right, so those are the first steps. We want to define what the need is. We want to go into the what you have section, select what can we include, what can be used to fund that need. And then I want to talk a little bit about the taxes here. So, and we're going to go into tax in a little bit more detail in the next scenario as well. But how the target maps work is we define here under the what you want, what the client needs net of tax. What do they need in their pocket in retirement in today's value? And then here under the what you have section, we take off a percentage that is what we call lost to taxes. So we're saying of that investment that I have and what I'm contributing to it over time, there is a percentage that is actually belonging to SARS. I'm going to take that off now, and I'm going to show apples versus apples. What is my net need versus my net assets once I've taken tax out of that equation. So we're comparing the net for net, and that's what we're going to see here in the what it means. So this is the page that's going to show up in our reporting, and we can see on the left, it's showing us these are the things that we've said Casey's retirement, what she wants retirement to look like. And for that, we would need a present value of 11, almost 12 million. And then based on what we can allocate towards this goal, the investments she has today, what she's contributing from now until retirement, plus the fact that she will be receiving a rental income in retirement, has a present value of 7.6 million. The difference, saying at an 8% return, that means Katie's 64% funded for retirement, and she would need an additional 4.3 million or to save 21,000 per month, increasing at inflation for the next 20 years. So this is our starting point. This is our base scenario or our current scenario. And from here, we'll start to look at different options for Katie. But I wanted to just move over to the cash flow and just talk through this a little bit more as well. So here we can see these bars at the top represent the income that Katie needs year on year in retirement. We can see the blue is showing that rental income and how that's funding a portion of that. And the difference is coming out of her pot of investments. So if we have a look at year one, we can see, and remember that this cash flow always runs from 1st of January till the 31st of December. So now that we're in May, this first line is looking at what are her contributions for the remainder of this year, plus the net asset value that we're bringing in. And together, this is the amount that's going into the pot in 2026. Growth is then added at 8%, giving us an end of year balance. And that continues year on year on year. So we keep adding contributions into the pot plus growth, and we see this end of year balance growing each and every year. Then we get to age 65 and we start drawing from that. So now we start looking at what is the income that Katie needs. Some of that income is being funded by that rental income that she's receiving, and the difference here is coming out of that pot of funds. And here we can see, well, how long can that pot of funds sustain it? And we can see that she's running out at age 80, 81. Okay. Another quick thing on the cash flow is that I can expand these columns. So I can have a look at what is starting and stopping when, and I can see, okay, there's no rental income being brought into the plan until age 65. I can see the expenses are starting here. And I can also make changes from here. So if I needed to edit something, I can click on this little link here, opens up that particular income need, and I can edit it right from here in the cash flow. Okay, but now we've got our base scenario. The next step I'm going to do is immediately clone it. And once I've cloned it, then I've got two copies, they're identical. I can immediately update this first one to say that is our current or base scenario. And I do that by just double clicking here, and I can type in baseline or current scenario, whichever words you prefer. Okay. But now in my next scenario, I can start to look at some of those levers. What are some of those conversations that I want to bring in to this discussion? And of course, here we talk about, the main levers are I can save more, I can spend less, I can work longer, I can, target a higher return. But there are a lot more levers. In Katie's case, we could bring in that inheritance and see the impact of that. There might be a sale of a business or bringing in a sale of a property. So now I can start to model those differences. And the first one I'm going to look at is, what if we targeted a higher return? This is always a great conversation with clients to just show the difference a percent can make in terms of targeting a different return. But of course, it opens up a risk conversation as well. Can we afford to take that risk? Is Katie comfortable with that risk? And what risk do we need to take in order to achieve her goals? So that's the first one I can update there. Now at this point, I can keep updating this scenario and look at other options for Katie, or I can immediately clone it again to say, okay, that's option one, but I want to look at a couple of different options as well. I can then update this to say this is at 9%. And then in my third clone, I can start to look at other changes. what if we looked at saving more? Now here I can see that she needs to save, a net amount of 10,571 per month, but perhaps that's not something we can do right away, but it's going to open up that affordability conversation around what can we start saving towards retirement. And I can do that by saying, okay, well, what if we saved in a discretionary investment an extra 60,000 a year, so 5,000 per month. Started that from now till age 65. And let's say we increase it by inflation and we want to take 10% off for tax. Maybe the point on just another point on the tax is we defaulted to 10% on discretionary and 30% on retirement funds. And that's just the nature and how they tax. So retirement funds will be taxed as income tax, whereas discretionary investments would be more CGT, interest and dividends. But I will talk a little bit more about tax now. So adding that in, we can see that got us to 87% funded. So, that jumped up quite a bit. But in terms of saving, I can also look at the escalations on the different savings products. So maybe if we can't save more now, I can say, well, what if we were to increase these savings by a bit more each year, as opposed to, adding additional savings? So of course, I can always go in here. I can update that inflation or increase adjustment on a certain contribution. And now we're up to 91%. So other changes I can make, I can look at, what if we, instead of starting to draw an income at 65, is there options to work longer? Or the client might say, actually, I want to work until 60 only, and then I definitely want to retire. Then we can have a conversation around, well, maybe that means I've got to take on more risk, or I've got to save more, or maybe spend less in retirement. So you can see how it's never sort of a straight line, but we're working through these different levers, these different trade-offs to arrive at the right combination for the client. How do we make those progressions? And then, of course, once I've created the scenarios that I want to look at, I can always use that compare feature by just checking these boxes here on the right, selecting compare, and I can see them all next to each other. I can also move it around if I want to put it in a specific order. So, okay, we want to look at, this is your current scenario. This is if we do nothing. You can see that we're 64% funded. But if we, take on a little bit more risk and target a return of 9%, then we move to 78. And then if we, on top of that, start saving a bit more, then we get up to 91% funded. Now, you could have many scenarios, but this is a great way of just surfacing those conversations. What are the different levers? What's the right combination for this client? And co-create that plan together. Okay. All right, so that's a pre-retirement example. I'm just going to jump across to this example. I'm going to go through a client in retirement now, but just before we do that, I wanted to touch on tax in a little bit more detail. So I've created just a very simple scenario of a client who's 65, he's got a living annuity, and he's drawing from that. Often when we talk about tax, the question we get a lot from planners is, if we take the tax off now, like I showed you in this pre-retirement example, deducting that 30%, are we not being sort of overly conservative because we're taking the tax off now and we're not getting that growth on that tax percentage over time? But in reality, whether we take it off now or later in the income, that growth component is actually on the tax, actually goes to SARS in any event. So if the fund grows and then we start drawing it and they take 30%, then it works out the same. So I wanted to just show you an example of the two different methods to show how the outcome is the same, and to also focus on what is important to understand around that. So in this example, I said, he wants 840,000 per annum from age 65 to 100, increasing at inflation. Currently, he has 24 million, and you can see I've put the 30% loss to taxes. So just like the example we did now, we can see that the client is 88% funded, and we can see that it's running out in 2055. But the other method is to say, what if I don't take it off the asset now, but rather when we're drawing the income, we take the tax off then. So I'm just going to show you in this example below, it's doing exactly that. So instead of just the 840,000 that the client wants net, I'm also added in a line item to say there's going to be tax on that. And, if we're drawing 100,000 out and 30% is going to tax and 70% is going to the client, kept it simple at 70 and 30, then 360,000 is going on tax. So in this example, I haven't taken it off the asset, but rather added it here so that it comes off as the client withdraws. We take off, this is your net drawing, this is the tax amount. What you'll see is that the percentage funded is identical between the two, whichever method we use, and it runs out at the same time in 2055. What you will notice is different is the shortfall, because the shortfall here is net of tax and the shortfall here is gross of tax. So that's where you will see a bit of a difference, but whichever method you feel more comfortable with, the result of when it's running out and what we do differently is the same. Now, the reason for that is because we're assuming we're using all of the retirement funds over the lifetime of the client's investment. But what really is key is not necessarily which method you use, but what percentage you deduct as tax. Now, we use the default is 30%, and that's because on average, a client's effective rate is around that. But of course, if you've got a client that you feel like their effective tax rate is going to be a lot higher than that 30% or a lot lower than that 30%, then you can adjust it. Regardless of which method you use, you want to put in what is that effective tax rate. And it's a difficult one because we don't know necessarily what it's going to be in 30, 40 years. But like all assumptions, we make, an assumption today that we think is defendable. And then the most important thing is that we review it every year and we look at all of the assumptions and adjust as we move forward. So I just wanted to segue into this quick tax conversation just around those two different methods, but either one that you use, one key thing to remember is that if a client is going to be left with a lot of funds on death, then the difference is going to show, because we're going to assume if we take it off the assets, we've taken it off now, and that whatever's left over is net of tax, whereas if you do the other method, it's going to be gross of tax. But in that event, the dependents are going to pay that tax on it in any event. So the outcome is the same. All right. Okay, let's move across to a post-retirement example. So a client that is in retirement. So if we have a look at Joe, okay, you can still hear me, Benny. Perfect. Okay, stop there for a second. If we have a look at Joe, Joe is now 70 years old. He's in retirement. And here we can see often the conversation around there's lots of different sources of income. So if we look at Joe, for example, he's got a living annuity that he's drawing an income out of. He's also got a unit trust investment, and we can see that he's drawing out 100,000 a year from that to fund his holiday spending. But in addition to that, he's got a guaranteed annuity as well as some rental income from this rental property. So lots of different sources of income from different places. Now, what is the question we're trying to answer for Joe? We want to know if these investments can continue to fund the income that he needs for the rest of his lifetime. And let's also assume in conversation with Joe that he said, actually the 684,000, he wants to increase that. He wants around 720,000 net per annum from his retirement funds. And that's the conversation we're having. So I'm going to jump over into the target map for that. So we've created it here, and under this what you want section, I've said you want 620,000 for income, but he also wants that 100,000 for travel, so 720 in total. But he did say, the next 10 years is the big ones. That's where he wants to do all the traveling and really have that lifestyle that he wants, and that's why he wants the 720,000. Now the question comes in, well, what can we include? What do we bring in to the what you have section in terms of how he can fund that? So if we have a look from the top here and we start with the annuity income that he's drawing from the living annuity, you'll see that I haven't included that. And the reason for that is we're drawing those funds out of the asset. It's not a guaranteed income. So we can't assume that the income I'm drawing from there is going to continue forever, but rather I'll include the living annuity asset that we're drawing from. And the same with the holiday spending that we're drawing out of the discretionary investment. Again, I will include the asset value that we're drawing out of it, but the income I'm drawing is not guaranteed. However, the guaranteed annuity, that I can bring in because now there's no longer an asset value. We're not drawing it out of the asset. The client is going to receive that from 70 to age 100, increasing at inflation, and there's going to be tax on that. As well as I've also included the rental income. Now, again, that's a conversation. We're including it for the, from 70 to 100. How sustainable is that? But for now, we're going to put that in as well. So what it's working out for us then is it's saying if this is the total income he wants, and this is what we can include. Some of it is going to be funded from the guaranteed annuity and the rental income, but the difference is going to have to come out of these two investments. How long can we sustain that? And we can see at an 8% return that it's 82% funded, and it's running out here in 2046. Now, again, I can start to surface what are some of the conversations that we can have. One could be, targeting a higher return. Another conversation in retirement is around the income patterns or the income levels that we use. So I've just created a separate example here. But I wanted to show, we see this quite a bit where you split it out into, what some refer to as the go-go years, the slow-go years, and the no-go years. Because what Joe really said is those first 10 years, he wants to really have the best lifestyle he can. So we've made that 700,000 for the first 10 years. But then in the slow-go years, maybe we can drop that a bit and have that as 550,000 for the next 10 years. But then in the no-go years, we can drop it again a bit more, but we also want to account for later life care at that point in time. So we bring that in again from 90 to 100. But I really wanted to illustrate here how we can have a conversation around different income levels at different points of time in that retirement span in order to then get to, 100% funded. All right. Okay, Benny, I'm going to close off there. Let me just share the last slide. So in closing, like we said, there's so many different factors that influence retirement planning. And, even working through this topic and doing the presentation today, so many other conversations came out of that. So I think we can have many more on it. So please share your suggestions. But I think the key thing is to think about in your process, when you're going through retirement planning for clients, what are some of the levers you want to engage clients on and how you can use target maps to really surface those conversations so that they feel that they understand it, they can make those trade-off decisions and feel empowered. Great. Thank you very much for joining.